Hi, it's Arjun. This week we want to address two questions that have come up from recent posts and video podcasts we've done. The first was after last week's video that talked about how inexpensive crude oil was versus gold, copper, refining, a whole bunch of different things. Why didn't we sound more pound the table bullish on crude oil? That question has come up and we'll address it. I think the second one is really around when we talk about maturing shale business and different business model opportunities for shale levered companies. We talked about going concern. We talked about selling to an M&A. What really does it mean, or could it mean to be a quote yield vehicle? And could you elaborate on that point? And so let's just get into it. We don't have a PowerPoint this week. We're going to just mostly talk to the camera. I got a couple exhibits on the second one that I will pull up here. Then the first question is, if crude oil is lagging and we're highlighting how cheap it is versus a whole bunch of different things, why were we not more pound the table bullish? And I think we want to make a few points here. First, our call since early 2022, as you all know, has been super vol, i.e. super volatility, not super cycle. We expect oil to at times trades towards 50, at times trades towards 100. Don't get carried away at either extreme. It is about generating good mid-teens returns or better, good per share growth, a capital return strategy, what have you, in light of what we expect to be a volatile environment. Plan and prepare for the inevitable dips. Don't get too carried away at the peaks. And who, therefore, amongst companies can come up with a differentiated mix of assets that will yield that double-digit to mid-teens returns, as well as attractive per share growth? And those are the ones to be excited about, who can lean in during the tougher times, and again, probably build cash during the better times. And, we reject the idea that you have to believe in a super cycle for oil or natural gas or anything to get behind at least the upper two quartile of companies. And I'm talking when upper quartiles, returns and growth. The better companies, as has been shown for all 100 plus years of the history of this business, they can actually outperform through all the ups and downs. And that's what we're focused on. It may be true that for third and fourth quartile companies, you need more of a super cycle. It's not our call. And we think there are companies that can kind of shift through the noise and do well. Again, last week, to get back to the question that was raised, we talked about how inexpensive oil was versus gold, which is a hard asset inflation hedge. Oil sometimes has those attributes, versus copper, which is often thought of as a China economic play. If copper's doing well and oil is doing poorly, maybe people are too bearish on China demand for oil. We looked at it versus refining margins, a direct commentary on oil demand, which has been certainly stronger than feared in recent weeks or months. And then, of course, natural gas. Oil is also all these things. Oil's cheap. Yeah, we had some wishy-washy language about not being able to say whether oil equities were values or value traps. And I got to be honest, a couple things. We have tried our hardest to not make short-term commodity calls at Super-Spiked, and we're running the risk of violating that. I think the critique of our wishy-washy language is a fair point. So let me just, we don't want to get into the short-term oil price guessing game. So some of the strength we're seeing now is tariff fears have receded, as some of the near-term demand numbers have been better. The idea that OPEC's kind of raising production to a seasonally better period, so it might not matter as much. Clearly, we've eliminated some of the near-term downside risks. And even in our recent CNBC appearance, we talked about this fall, when the seasonals roll over, could that be a point of risk? All of that stuff, we have tried our hardest to avoid commenting on it here at Super-Spiked, and it's our mistake for wading into it. So let's get back to our core tenets. Oil equities, those companies that can generate double-digit mid-teens returns and attractive per share growth, perhaps through stock buyback or other means, I think are significantly undervalued today. As we've said many times, we see structurally better profitability for industry at large, including the top two quartiles of companies in this decade, especially versus last decade, which is very performance. And our generally positive view of traditional energy has been driven by that. Much better profitability through all the ups and downs, super vol, not super cycle, this decade versus last decade. So, traditional energy is about 3% of the S&P. Our view is that it will get back into that 8 to 12% range. by the end of this decade, there is no change to that view. We should have been more emphatic last week. We have commented that when you get to those extremes, which we'd call kind of around $50 oil on the downside, towards $100 oil on the upside, but on the downside scenario, that having a flush is often easier from a trading standpoint. We're like, okay, we're at trough returns. That classically is the pound the table time. We're not at that. We don't like making this short-term commentary. We're again trying to do it again. We're going to stick with those companies in the top two quartiles of returns and growth, per share growth, are significantly undervalued today and will do well over the course of this decade. Let me just make one final point. So will oil sell off again this fall? We don't know. We're going to see whether the hard data, which has been stronger across the economy, including oil, catches down to what has been soft data, if you will, the sentiment, the consumer sentiment, and those kind of indicators. Perhaps that data starts to improve. We'll see how that all plays out. We'll see if there's any adjustments to production levels and so forth in the back half of this year because the rig count's down in the US, and whether Saudi and some of these countries ease off on some of the near term. All that has to play out. What we would continue to suggest is when you're below mid-cycle, when you're at the lower in the range, that is the time to lean into the sector, whether you're a company or an investor. When you're at those above normal times, let's just call it 80 or above, those are the times to be more concerned, to express more caution. I think, to me, that has long been our advice and commentary, and we need to do a better job of emphatically stating it and not getting into this wishy-washy, short-term guessing game of where prices are going. Plenty of people out there to play that game. I think the second big topic or question we wanted to talk about today is what kind of capital return model could make sense for companies especially exposed to the shale business. So again, just take a step back for a second. In our recent post, The Good, the Bad, and the Misunderstood from 2 weeks ago, we talked about growing shale maturity, growing evidence of that, and what that could mean, where shale has been, 90% plus of net global oil supply growth over the last decade. And you've just seen a wide swath of business models, whether it's upstream or services or what have you, really become geared toward the US shale business, rightfully so. So at a time of what originally was rapid growth, now has become more a period of generating better returns on capital from the historic growth and the assets that have been accumulated and all the consolidation we've had happen. How do we think about go forward? And there are kind of three good outcomes we've talked about for publicly traded companies. We either evolve into a going concern, which usually means you have a diversified asset base. It could be by country or region. It might be integrated, but you don't have to be integrated. And through a mixture of short-lived, long-lived assets and so forth, you can generate mid-teen returns, have dividends, growing stock buybacks. Historically, this has been the largest historically integrated oil companies. I don't think you have to be just integrated to employ a going concern approach today, a favorable one. So it's not just the super majors we're talking about. But clearly, if you're a pure play shale E&P, I think a lot of investors are going to say, how many of these guys really should be diversifying? It's not zero of them, but it's also not 100% of them. And it's probably closer to zero. It's probably a handful, maybe more than a handful of companies where you'd say, okay, a diversification strategy, whether it's global or otherwise, might make some sense. For a lot more of them, I think the questions are, how do you think about, and can you, or is it too late to sell to a larger company? Or if it's not about diversifying, is there some, I've called it yield vehicle, that may not be the greatest term, strategy to employ? And in all cases, we want to avoid the two bad outcomes, which is regressing to just being a cycle rider, as we call it, where you just go up and down with commodity prices. For those companies, you would need a super cycle to really own them long term. You don't want your company to have to be based on having a super cycle, would be my opinion. Certainly not a publicly traded company today. Worse than a cycle rider is the living dead. Those companies that perpetually and structurally underperform the S&P 500, not just during the down periods, but throughout all the ups and downs. The living dead, we have some of those in our sector. We should all have the fear of God to not want to turn our company into the living dead. But I think that also holds for the cycle rider. So what are the examples? So the real question is, people get selling in an M&A situation. People, I think, understand what I mean by going concern. But are there yield vehicle examples that would apply, especially to upstream-oriented companies, whether that's E&P or perhaps the oil services sector? And I want to go back to a note we published about a year ago that included commentary on Murphy USA. They were they are the retail gasoline downstream spinoff. It happened a little over a decade ago, I want to say, from the E&P company now Murphy Oil that I think most people know. I'm going to pull up a couple charts on Murphy USA. Okay, so first of all, I'll apologize if this isn't as pretty as it should be, but this is a Bloomberg exhibit of Murphy USA versus the S&P and the XLE, the XOP, and the OIH, so three traditional energy indices. And this goes back to the start of 2015, and the Murphy USA has smoked all of the traditional energy areas. Now keep in mind, they are a gasoline retailer with a convenience store business as well. Does anyone think US gasoline retail has been in a structural bull market, or some massive secular grower, or some undiscovered kind of thing? I mean, look at that stock price performance. It's even smoked the S&P 500. Now, that's been more recent since 2021, but it kept pace during the bad days of the second half of the 2015s for traditional energy, smoked traditional energy throughout it, and is now just beating everything even after a little bit of a pullback here. Murphy USA, in what is an absolutely non-sexy kind of business, has simply crushed the competition. And what can we learn from that for these lagging areas? So now let me pull up a second chart here. In what is a non-sexy, non-structurally growing business, U.S. retail gasoline demand, what has made Murphy USA, such a successful stock? They clearly have executed well in their base business in terms of managing costs and margins. They have kept reinvestment rates low. They have done selective acquisitions to bolster their network, and they have primarily used free cash flow to return capital back to shareholders, in this case through stock buyback. So in this second chart here, you can see the reduction in their share count. Over this decade period, shares are down about 55%. That works out to an annual reduction of anywhere from 7 to 8%. 7 to 8% reduction in shares, even if you have a flattish top line business, I'm going to argue is going to get you a per share growth rate that, while it may not be competitive with your Mag 7 when they're all rock stars, I think will prove to be competitive with the broader S&P 500, especially if you can supplement things with some bolt-on acquisitions from time to time. A couple metrics to look at here. First, in terms of cash-on-cash returns over the last decade, Murphy USA has actually been mid to upper teens, 17%. And actually, in the most recent period, it's up to 20%. Their reinvestment rate over the full period is actually pushing 60%. In the most recent period, 40%. And I think what encourages me and why we think this type of model is perhaps applicable to some traditional energy companies is when we look at first the profitability. Historically, the downstream companies have been sort of low to mid-teens and more recently mid-teens. And then you've had the IOCs, and this includes like 6 bad years where you had kind of cost of capital returns. But in the more recent period, we're starting to get to the threshold. And this is for the sector at large, where we're showing IOCs, E&Ps oily, and E&Ps gassy. We need to follow up on this in more detail. But if you actually disaggregate that to your first and second quartile companies, you're going to get croakies, cash-on-cash returns that are in that mid-teens or better kind of level that look more like Murphy USA. Same with the reinvestment rates. I mean, again, you can see E&Ps historically invested over 100% or 100% of their CapEx went back, of their cash flow went back into the business. We are now in more recent years pushing 40 to 60% reinvestment rates. Now, and I know one of the critiques will be, well, when you have a gas station business, it's inherently long-lived and shouldn't need that much reinvestment CapEx. There's a lot of truth to that. Where an E&P asset inherently declines, and that's where I think you're going to have to disaggregate these companies in terms of what is their real inventory life to sort of keep production flat or maybe grow it up to 1%. What kind of reinvestment rate would that take? There's probably going to have to be a need for bolt-on acquisitions from time to time. But if we can gain confidence that through all that X acquisitions, you can feel good about kind of a 50%-ish type reinvestment rate. If you can feel good about mid-teens or better croakies, and I'm going to say at a normal oil price. So the other thing I would say is for 2021 to 2024, I want to say WTI averaged $78 a barrel, something like that. That may be a few dollars a barrel higher than what most people would consider normal. 70 to 75, I think, is a reasonable normalized oil price. So there may be still a little bit work to do. But again, this is for the sector at large that I'm showing in this picture. You disaggregate this to your top quartile companies. I think there is the opportunity for at least some of these companies to think, I call this yield vehicle, it's capital return strategy, what have you. I want to make sure I'm clear on a couple points when we talk about Murphy USA as perhaps a role model for some set of companies. We are not saying, I'm going to repeat it, we are not saying that stock buyback is the be-all, end-all answer for all companies. It absolutely is not. Our comment is that for some companies, this might make sense. I'm thinking in top of my head now, there may already be some notion of a diversified, at least a diversified shale asset base where you're in more than one basin. I'm observing that some companies are doing really good on executing their current drilling programs where the drilling costs and the operating costs continue to get better, and that there are opportunities to continue to enhance recovery, that we've gone X growth, that is a financial orientation. And again, who has enough of an inventory life to perpetuate, I'm going to call it mid-teens or better croaky. And again, think about how do we just continue to execute better day in, day out, where there will be opportunities for bolt-on acquisitions in a variety of different places where we're not held to, oh, you're a single basin pure play, and if you do anything, you're going to ruin your, it's not for everybody is my point. You'll often hear in the shareholder activism stories a de facto stock buyback argument. And I think sometimes the activists are right and sometimes you're wrong. And so we're not trying to go down that road and say, oh, we need to force this on every company. I just want to be as clear as possible. This is not for everyone. You have to have the attributes where it makes sense, and both the mindset and business model and organizational structure that is going to embrace this kind of approach. But you can't look at Murphy USA and not say, there can't be zero companies that's applicable for in our sector. Okay, it's retail gasoline, people. That's a very mature business. It is completely unexciting. By the way, what Murphy USA does fit into one of our other themes, reliability and affordability. It's a low-cost gasoline model, so they're not, to my knowledge, it's not based on some premium gasoline price premium model. It's the opposite. Low-cost gasoline, affordable, reliable, not totally analogous to an E&P and oil services business model, but I think you get the point. When it comes to the bigger oil companies, this could be super majors, integrated oils, or even other large companies. We're not saying that this model necessarily makes sense for them. These are companies that actually have shown they can do a whole series of different projects around the world. It could be some international oil developments. It could be the LNG business. And they've historically had a business model of generating mid-teens returns and doing a combination of dividends and stock buybacks. So I actually think this is not an argument that the largest oil companies should pursue a stock buyback strategy a la Murphy USA, where it's a real explicit thing that you're doing. To me, it's frankly some of the mid-sized type companies, maybe even some of the smaller ones, where there can be an interesting opportunity for, again, the bolt-ons that can add inventory life, but where you can get that combination of profitability and reinvestment rates such that the stock buyback math isn't just a temporary thing. It's true there is likely more volatility in the traditional E&P or oil services business from a pricing standpoint than there might be for the margins of a Murphy USA. So again, the analogies aren't perfect, but I think the business model is worth studying. It is not for everybody. We'll keep repeating that, but I think it is for some companies. Shale is undoubtedly maturing, even if it's still going to be around for a long, long time, even if someday tier 2 and tier 3 makes a whole lot more sense. And so there is a need to think a little bit differently in a world that is super vol and not super cycle. It is incumbent upon management teams and for investors to figure out the management teams that have differentiated strategies. We can't just sit around waiting for the macro to bail us out. That is not a winning strategy. And our goal is, in this sector, to do better than the broader S&P 500. So I'd like to end this video on a personal note. And we're gonna dedicate this to mom and dad. I promise we will not be sappy about this. This is about what have mom and dad contributed to Super-Spiked. Now, by way of background, parents are 85 years old. For certainly 84 of those years in good health, good minds, all that kind of stuff. And as you'd expect, as you're getting older, you're going to have some health challenges arise. But we're going to focus this on what they have contributed to Super-Spiked. And so, a lot of people. So let me start with my father. He is a physicist by background and career, a scientist, and one of his key lines has always been, "You have to have a questioning attitude." And I feel like I embody that perspective that he's always talked about in terms of his career as a scientist. It is what has been the motivation to have created Super-Spiked. We rejected and completely pushed back on the energy transition narrative, which I've spoken exhaustively about, that very narrow mindset that we all had to accept, this sort of received wisdom about settled science, and that these declared narratives about everyone has to be net zero by random short time frames. We push back on all of that. I believe the world is coming our way, and we feel good about that. But that idea that you should have a question attitude and not just accept conventional wisdom, we'll put that in the checkbox of that is something Dad has brought to the table. When it comes to Super-Spiked and the reaction from many of you, I'll often get some very nice feedback that, Arjun, you seem like you're pretty even keeled. You generally try and smile throughout these things and bring kind of a pleasant approach. You don't attack directly, at least not competitors, or call out people in sort of an angry way. And I think we're going to give Mom credit for the demeanor. Now, both parents, highly educated. They came to this country to go to Cornell University, get an advanced degree. In the case of Mom, she was going for a PhD when yours truly came along. And they will say that they both made a mutual decision that Mom would stay home and take care of myself and what soon became my two siblings. I'm going to maybe have a questioning attitude about that full story there. It was 1969, 1970s. They both hail from India, traditional marriage in many respects. So how, whether it was sort of more expected versus voluntary, we can probably leave that to personal conversations and so forth. But my mom brings her own set of sort of very smart person in her own right and did a great job. I think they both did. A lot of people say, "Hey, you're a lot like your dad." I'd say, no, I think I'm a greatest hits of both of them. So with that, thank you, and we'll see you next week.